Cryptocurrency, a solution to traditional bank failures in 2023. The recent bank failures in 2023 have sparked concerns about the stability and reliability of the traditional financial system. In light of these events, many have turned to cryptocurrencies as a potential alternative to conventional banking. This article will explore the concept of cryptocurrencies, their potential to replace traditional banks, and the challenges they face in achieving widespread adoption. Cryptocurrency, an overview. Cryptocurrency is a digital or virtual currency that uses cryptography for security and operates on decentralized networks called blockchains. These networks are maintained by computers or nodes, which validate and record transactions. Cryptocurrencies such as Bitcoin, Ethereum, and others offer various benefits, including lower transaction fees, increased privacy, and protection against fraud and inflation. The appeal of cryptocurrency in a world of bank failures. The recent collapse of several traditional banks has exposed the inherent risks of centralized financial institutions. A significant advantage of cryptocurrencies is their decentralized nature, which means that they are not tied to any single authority or institution. This feature provides increased security and stability, as the failure of one node does not impact the entire network. Additionally, cryptocurrencies offer faster and cheaper transactions than traditional banking methods. Without the need for intermediaries, users can directly transfer funds to one another, avoiding the high fees and delays often associated with international transactions. Moreover, cryptocurrencies can potentially offer financial services to the unbanked and underbanked population who may lack access to traditional banking due to geographical, economic, or bureaucratic barriers. Challenges to replacing traditional banks. Despite the potential benefits of cryptocurrencies, several challenges must be addressed before they can replace traditional banks. Volatility. Cryptocurrencies are known for their price volatility, which can deter users from treating them as a stable store of value. This instability might discourage widespread adoption, as users may be hesitant to use cryptocurrencies for everyday transactions or long-term investments. Regulatory uncertainty. Cryptocurrencies face an uncertain regulatory landscape, with governments around the world taking varying approaches to their classification and taxation. This lack of clarity may hinder the growth and adoption of cryptocurrencies, as businesses and users may be reluctant to invest in an asset subject to sudden regulatory changes. Scalability and energy consumption. Many cryptocurrencies, particularly those based on proof-of-work consensus mechanisms like Bitcoin, face scalability issues and high energy consumption. These factors can limit the transaction processing capacity of the network and contribute to environmental concerns. Security and privacy. While the blockchain technology underlying cryptocurrencies offers robust security, issues such as hacking, fraud, and user error can still occur. Privacy concerns also arise from the public nature of blockchain transactions, which can potentially be traced back to individual users. Conclusion. The recent bank failures have highlighted the potential benefits of cryptocurrencies as a more stable and secure alternative to traditional banking. However, the road to replacing traditional banks is fraught with challenges, including volatility, regulatory uncertainty, scalability, and security concerns. It remains to be seen whether cryptocurrencies can overcome these hurdles and reshape the global financial landscape. In the meantime, it is crucial for governments, businesses, and users to work together to create a supportive and adaptive environment for the growth and adoption of cryptocurrencies.